Good evening. Thank you for joining us tonight during this webinar. My name is Keith Yell, and I am an investment advisor. One of my passions in life is helping people save money and helping them achieve their goals. So obviously, it's kind of a natural calling for me. The class tonight has some useful information for you. I can't go too in detail, but you're going to get some great concepts in how you can reduce one of your big expenses in retirement, which is taxes. Not only do we already know that in 2026 tax rates are going up, this temporary tax cut that went into effect only lasts through the end of 2025. But due to what's going on right now and why I'm on a video screen and maybe not, in a reception hall or somewhere else giving this is the COVID epidemic. The government's already printed about $4 trillion trying to solve this problem. And I don't think they're done injecting liquidity into the system. Well, at some point in time, that money is going to have to be paid for. And so personally, not only do I know the taxes are going up in 2026, I think they might go up sooner. And if they don't, I think they're going to go up more than what we're anticipating. So grab a pen and a piece of paper. I'm not going to try to take up your whole evening. I know it's beautiful outside, but hopefully about 35, 40 minutes. And everyone will have the opportunity. This is really a two-part webinar. The first part is what I'm doing right now. And then second, everyone's going to have the option to reach out to me and to connect one-on-one so that I can answer questions individually. This platform doesn't really allow for us to do that, but you're going to see this across your screen a couple of times. And all you have to do is you click on that and you can just email me and let me know that you'd like to set up some kind of other communication as far as talking on the phone or via Zoom to do a little one-on-one. So you'll see that pop up on the screen a few times this evening. You just take advantage of that so we can set something up that I can really help you out, answer your questions. I'm going to read this as a legal disclosure. But after this, we're going to jump right in. The presenter is in no way employed, affiliated, or endorsed by the IRS, Social Security Administration, or any other government agency. This presentation is not intended and should not be construed as tax advice. Please consult with an enrolled agent, CPA, or attorney before implementing any of these strategies. All examples are hypothetical and for illustrative purposes only. Actual results will vary. No part of this presentation is intended to make an offer, sale, or purchase of any specific product. Well, in our firm, we actually have a tax preparer. So we're a tax office. So this is kind of what I help people do on a regular basis. But what we're going to really focusing on tonight is the current tax system. I want you to understand how things have changed since prior to the Jobs Tax Cut Act of 2017. I want to identify some tools and some strategies and some concepts for you to understand things so that you can pay attention on yourself. Definitely not going to get into any kind of politics tonight by any means. If this is you and your spouse, when you're trying to do your taxes or trying to understand tax law, you're definitely not alone. The tax system is not really intuitive. My feeling on that is, the tax system is overwhelming and it's meant to be so. Because honestly, any politician can go into office, claim that they cut taxes, and they won't be lying. Because there's about 800 plus items in the tax code, they could cut or reduce 2 or 3 of them and honestly look at a camera and smile and say, I cut taxes. They're not telling you about the 650 taxes they raised, but the tax code is confusing. And it obviously, if it was easy, everyone would do their own taxes and we wouldn't have a problem. But we do have a problem and a lot of people don't know about it. And I want everyone who's watching tonight to pay the taxes that they owe, but I don't want you to pay a penny more. And just by shifting the way you do a few different things in your life and how you pull maybe on some retirement income, which is what I specialize in, you're going to really be able to save a ton of money on taxes just by paying attention to how the tax code works. So this is what the current brackets are for 2020, just to take a look at it. So, we work in a marginal tax system, which means that, if your income falls into that threshold of $0 to $19,750, all the money that falls into that, you pay 10% federal tax on. The next dollar above that, you're going to pay 12% tax on. And if your wages are above $80,250, then that next level is 22% bracket on. Just because you get to the higher bracket doesn't mean all your income is taxed at that higher bracket. It works its way like a staircase. It's just that dollar that falls within that bracket. Here's another way to kind of look at that same exact bracket just so you can kind of understand. So you can see that lowest tax bracket, that 10% level, where all the money in there is taxed at 10%, 0 to $19,750. If you do your own taxes, you might recognize this bracket because it's actually printed in the tax form when you're looking at things, how the IRS helps you out. So if your income was $30,000, you're going to look over there and you're going to see, well, I know I owe $1,975 to cover that full 10% bracket, and then you're going to owe $11,249 in that 12% bracket. That's going to be taxed at 12%. So it just kind of elevates each level you go. And finally, here's just kind of a third way to look at things if for everyone learns differently and understands things differently. This is kind of a visual map showing you where the brackets bump. You see there's a 10% bracket, 12, 22, 24, and 32. And you'll notice, obviously, that there's a big jump. There's some big jumps there. Like 0 to 10, that's a big jump. 12 to 22, that's a big jump. And then 24 to 32, that's another big jump. So really what you want to focus it in on is if your income falls around these levels, you really want to pay attention to how you're pulling your income. Because I know, for my clients, I'm advising them, we want to take full advantage of this 12% tax bracket that's available right now. In 2026, that 12% bracket is gone. And it's going to be 15%, just like it used to be. And the 22 and 24% brackets, those will also be gone, and that's going to be 25%. So if you're near retirement or you are retired and you're trying to figure out how to draw on your income, you don't want to waste these brackets if you know that your income down the road is going to be higher or the same. You really want to utilize that. I know I'd rather pay the government 12% now than 15% later. Unless you like to kick the can down the road or you're a glutton for punishment, you've got to pay attention to this stuff. Right now, the tax rates right now, I'm 45 years old. The tax rates right now are the lowest since I've been alive. And my gut feeling tells me that these are the lowest tax rates that I'm going to see in my lifetime. Like I said, they already revert back in 2026. And with this COVID thing, the Fed's balance sheet has gone up over $4 trillion already. So it's just something to think about. I want you to really all be aware of it. And we really have only 2020 through 2025 to really take advantage of all this. Perhaps even not that long if the tax code were to get changed sooner. So that's basically what we just talked about and described was marginal tax rates. It's the tax bracket that your last dollar fell into. So like we said, if you made $85,000, that money that was just above $80,250 would get taxed at that 22% level. The tax code works in many different ways. Like I said, it's not simple. So we just talked about income, ordinary income that's taxed. Those are the brackets we looked at. But there's other kind of brackets too, and they all kind of overlap. So capital gains and dividends get a different tax treatment. The government wants to do this. They always are promoting people to invest their money, to create more, to create a bigger economy. So they're giving people a tax break on capital gains and qualified dividends. The concept is very similar to that marginal tax bracket. It's just a separate bracket that then overlays. And I know that this can get confusing. That's why we're looking at everything one item at a time. Prior to this most recent tax act, the Tax Cut and Jobs Act, these were linked together, but now they're slightly askew. I'm not sure why they did that, but they're just slightly askew, but you'll take a look and see. The capital gains bracket right now is if you make less than $80,000 a year, your capital gains tax would be 0%. When I ask most people, what do they think the long-term capital gains tax is? They say 15%. Well, they could be right, but it depends, just like anything in life. The highest right now, the long-term capital gains tax rate is 20%. But if you're smart about things, you want to keep it in that 0. What this means, though, is these capital gains, they get stacked upon your ordinary income. So if you made $60,000 and had $30,000 in long-term capital gains, you're going to see that you've got $10,000 above that threshold of 80. Goes your income, then they stack on top of that the capital gains. So your first 20,000 would have 0 in capital gains tax, but then your last 10,000 would have that 15% rate on it. Why this is important, especially when you're near retirement? Well, some people have a second home, especially in Rhode Island. They might have like a beach cottage. Maybe you have like a house up in New Hampshire or for camping or things like that. Some people have, or even like a timeshare. what that entails you to do is when you retire, you have the most control over your income that you've had in a long time, other than if you just wanted to quit your job. But the odds are pretty good that you were helping raise a family, supporting yourself. You had to make money, and you were focused on saving and making money to get ready for when you were about to retire. Well, now that maybe you're approaching retired or recently retired, the best opportunity you have, I can't think of a better time to be a pre-retiree or a retiree right now who's just getting into the game, because of where the tax system is and the fact that you are in control. You don't have to turn on your Social Security if you don't want to. That's up to you. But you get to control. So if your income that's coming in is zero and you had a second home that maybe you bought it at $100,000 and you want to sell it, well, the ideal time to sell that second home would be before you turn on any sources of income like Social Security or a pension, or start taking money out of your IRA, because you could get the first, and it's actually a little bit more than $80,000, and I'll get to that in a little bit, but you could actually get $107,400 if you're married and over 65, that your first $107,400 of capital gains could be tax-free. So you might want to consider that if you have a property or a big item that you're going to sell for a gain. Maybe you're lucky enough to buy Apple or Google or Amazon stock a long time ago and you want to unload some of it. Well, the ideal time to do it is when you don't have other income just pad underneath it, so you can help shave those taxes down. This is just that same map, a different way to look at things. And if you'll notice, it's not at $80,000, right? The 0% doesn't go to the $80,000 mark. What this graph does is exactly what I just said. It's adding the standard deduction on top of that. So in essence, that $80,000 cap on capital gains taxes, well, we also know that if you're married and over 65, your standard deduction is $27,400. So you can stack that on top of the $80,000, and that's how you can get that total amount of tax-free capital gains income in retirement if you organize yourself correctly. Next, I want to just quickly touch on deductions, exemptions, and credits and how they're different. A deduction, basically, if your income level is $100,000, all a deduction does is it lowers the amount of your taxable income. It doesn't actually directly lower the amount of tax you owe to the government. It indirectly lowers it by lowering your taxable income. The deduction that most of us are probably the most familiar with is the standard deduction, which right now for a married filing joint couple is $24,800, but you get an extra $1,300 per person if you're married and over 65 or blind. And also, if it's just one of you, if you happen to be a widower or a widowee, instead of that extra $1,300 bump, you get $1,650. So it's a little bit different. The rules are a little bit different. But that standard deduction amount, basically, if you're making $100,000 and you don't have a lot of other itemized deductions anymore, well, you would take that standard deduction. The government did that in the new tax code to try to simplify things for people. It changed things around. So this is the highest standard deduction that we've ever seen. It's going to go away in 2026, though. So you kind of want to capitalize on, like I said, the tax code where it is right now. You're allowed to now only deduct your state and local taxes for itemized deductions up to $10,000. Mortgage interest up to $750,000 on your primary. That doesn't include a home equity line of credit. You used to be able to go take out a home equity line of credit, buy a car with it, and then write that interest off in the home equity line. You can't do that anymore. The rules are very specific, and it has to be only used for improvements on the home. And then even then, you need to talk to an accountant before you do it. Charitable gifts of cash or check, up to 60% of your income is still an itemized deduction. You could also donate goods that have appreciated. You could donate stocks or other items that have appreciated in value up to 35% of your income. There's no more personal exemptions. So the government basically said, by increasing that standard deduction, we're simplifying the tax code. Personal exemptions are now gone. So people who have a lot of kids, they might not have been happy. Credits. Credits work differently than what I just said on deductions. Deductions lower your income that's taxable. Credits actually lower the dollars that you owe the government. So if you did your taxes and you owed $2,000 to the government, but you had a sharp accountant and they said, hey, if you do this, you'll get a $500 credit. And you're like, okay, well, let's do that. The $500 credit actually reduces the dollar for dollar of what you owe the government. several of the credits out there that are popular. The healthcare tax credit, that's part of the Affordable Care Act. Basically what that is a tax credit. It's based on your family size, the state you live in, and your income. And it determines, if where your income level is, you can get a break on the cost of your health insurance if you buy your health insurance through the state exchanges. There's the earned income tax credit. That's calculated very much the same way. Those are for lower to middle wage earners, calculated by the amount of money you make and the members in your family. And if you're below certain thresholds, you get a tax credit to try to help you out. There's different educations you could potentially take for your kids who are in college, perhaps, or yourself. Excuse me. There's the lifetime learning credit, and there's the American Opportunity Tax Credit. You have to kind of figure out which makes the most sense for you. There's actually a Savers Credit, which I'm going to give you an example of in just a few slides. This is a great credit if you're kind of strategizing. If you're a pre-retiree who thinks that you might work in retirement because you can't go from full speed to just sitting and watching the birds go by. If you're that type of person who knows yourself and you like to stay busy, well, you might take a part-time job, or maybe COVID has forced your jobs to now become part-time. This is a great credit, which basically on top of contributing money to your IRA, where you would get a deduction, you can actually get a credit on top of that. As long as you control your income and really pay attention to what you're doing, it's one of the best credits out there for retirees who work part-time. And then there's the child credit for people who have children. So this is an example right here of that Savers credit that I was just speaking about. Now, it caps off and it phases out depending on how high your income is. If your income is below $38,100, then you can get a 50% credit on your IRA contribution. But the credit still exists for your income being as high as $60,000 a year. And the way that you can kind of strategize your income is you have to remember that money you have in your checking or savings account or money you pull from a Roth IRA doesn't count as income. It's not taxed. You've already paid taxes on it. So that's tax-free money that maybe you lean on a little bit so you can strategize and take advantage of the tax system. It's all these little things that you can do to save yourself hundreds, if not thousands, or even tens of thousands of dollars. And like I said before, your tax bill, if you're a relatively healthy as a senior, as a retiree, your biggest expense is more than likely going to be taxes, unless you have an expensive car habit or something like that, But for most people, it's taxes and health insurance is what costs them the most in retirement. The way the Savers credit works for this couple is this. One of the people basically worked part-time in retirement. He's one of those go people that finally retired, but still couldn't just stand still. So got a part-time job. He made $38,000. Between the two of them, they made $38,000. Well, they're both over 65. So on their tax paperwork, this is what it would look like. Their gross income of $38,000. They didn't have a lot of itemized deductions, and for most people who kind of have for most people, that's the way it works. Very few people itemize anymore. So they took the standard deduction of $24,800, and then because they're both over 65, they get that extra $1,300 each. So that total deduction off their income right off the bat is $27,400. Now, how they take advantage of that Savers credit is they realize that, hey, we don't even need all this money that we're making right now. We're living off of other funds that we have. But if we just happen to put $2,000 into a traditional IRA, we're going to get a $2,000 deduction off of our income right there, which is going to lower our income subject to taxes to $8,600. Well, I showed you prior in other slides that 10% bracket goes up all the way to $19,750. So we know they're all in that 10% bracket. So that $8,600 only falls down to a federal income tax obligation that they would owe of $860. But because of where their income level fell below that $38,000 level, they get the full 50% of their IRA contribution also as a tax credit. So they're getting $1,000 applied to what they owe. And you're going to look at me and say, hey, Keith, the math doesn't make sense. If they owed $860 and the government's going to give them $1,000 credit, shouldn't they get $140 back? And your math is correct. The problem with tax credits is there are some that are refundable, meaning the government will actually pay you if you've already covered every dollar that you owed them. And there's others that are non-refundable, meaning it'll only cover the taxes up to what you owe the government. This is one of those non-refundable credits. So that's the difference between a refundable credit and a non-refundable credit. If you ever had that inkling or question in your mind, now you know. So this is just going back to that married filing joint bracket. We're looking at that. This is adding in that standard deduction. So you can see that no matter what, if you're married and over 65, your first $27,400 is tax-free income, because the deduction wipes out everything that you would have claimed as income. And then the tiers go up. The next is that 10% bracket, and then the 12% bracket until we get to 22. This is basically just adding in the standard deduction to each of those. So that's how it would look. So it'd be great if what we talked about, the bracket, the capital gains bracket, all these other things, if they worked independently. That would make it very simple and easy enough that anyone could do their own taxes at home. But that is not how things work. Everything and all these rules get layered on top of each other, and you've got a lot going on when you get into retirement. You've got the most control, but you also have a lot more going on. And it only gets more complicated as you get older, and I hate to say that. I know when we graduated high school or college or finished an intense career where we had to always learn, maybe we're ready to rest a little bit. No. The government's going to force you to learn all about Medicare rules, all about different Part D supplements and which one's the right for you. And they're also throwing a lot more at you. They're throwing required minimum distributions at you. There's the whole separate tax item for that. Capital gains. You've got to start thinking about that. You've got to start thinking about Social Security, the Medicare I mentioned. We want to talk about, and what I'm doing for a lot of clients now, you have to figure out if it's the right thing to do for you, is Roth conversions on your IRAs. Let's pay lower tax rates now, because we know in 2026 the tax rates are going to be higher. And with our required minimum distributions, once we hit the age of 72, the government's going to start forcing us to take money out of our 401ks, our 403bs, our IRAs. It used to be 70 and a half, but because of recent legislation that was passed late last year, now it's 72 is when you're required minimum distribution. The other thing you should know is if any of you are over the age of 72, or you started taking required minimum distributions because of the timing of things. Right now in 2020, because of COVID legislation that passed, nobody has to take their required minimum distribution this year if they don't want to. Some people, when they get to retirement, they don't even need that money anymore. They're living off other money, and they don't want to be forced to take it out and pay taxes on it. Well, for 2020, required minimum distributions are not necessary. You do not have to take them for this year alone. I'm going to get into talking a little bit about the net investment tax and the alternative minimum tax and a couple other things that got wiped out in the tax code too. So I just kind of talked a little bit about RMDs. You have to start taking them the year you turn 72. And actually, you have until April 1st of the year after you turn 72 to take out your first one. But after that, it's by the end of the calendar year. For that first year, they give you till April 1st of the following year for some reason. But after your first RMD, it all kicks out it has to be done in that calendar year. And you don't want to forget to do that, because the tax penalty on forgetting your RMD is one of the biggest tax penalties there is. It is 50%. So if you were forced your RMD, you're supposed to take out $10,000 and you forgot to, you're still going to have to pay taxes on the $10,000, and you're going to pay a $5,000 penalty. So not something you want to miss. The way you calculate your RMD is this, and a lot of people are kind of a little bit confused by it. But basically, you're going to be looking at the IRS table of life expectancies, and it's going to kind of show you how many years the IRS hypothetically expects that you're going to live. So let's say that I turned 72 tomorrow. Well, I know that this year I'm supposed to take my RMD. Realistically, I could kick the first one out until April 1st of next year because it's my first one, but we're not going to play that game. So what the IRS would do is they would force me to take a look at the value of all of my accounts, my IRA accounts. And if you have 401ks and 403bs and all these different things, you're going to have to do it for each type of account. You'll have to do it for all your IRA accounts, all your 401k accounts, all your 403b accounts. So as you get older, you might want to maybe transition all of those qualified accounts, and those are the accounts that you haven't paid taxes on that money yet, that you saved to get to retirement, you still have to pay taxes on it. But what you might want to do is do rollovers to have everything classified as IRA. And the reason why you'd want to do that is it's going to make your life simpler, and it's going to make your overall investment planning and your strategy a lot simpler as well. I can get to that in our one-on-one sessions. I'm not going to dive too deep into that, but this is just something I want you to remember. So what the IRS is going to do is they're going to tell me to take a look at the balances of all my IRA accounts on December 31st of last year, of 2019. Let's say I was lucky enough to save $500,000. Well, what the IRS is going to say, they're going to say, hey, Keith, this is the year you turned 72. The total balance was $500,000. We're going to divide that by what we expect your life expectancy to be. And they're telling me that I'm going to live another 25.6 years. I should be so lucky. But that's what they're going to do. I'm going to divide $500,000 by 25.6, which ends up being roughly about 4%. So I'm going to have to take out $20,000 if I have $500,000 in IRA money. So there's a couple different ways that you can kind of manipulate that, but you have to plan in advance. You could do those Roth conversions. You could maybe you don't take your Social Security right at age 70. Maybe you start utilizing some of the money you've saved in retirement to spend some of it while tax rates are low. There's all kinds of different strategies, but everyone is unique. Everyone's situation is unique. Capital gains, I kind of talked about how already they're taxed. Well, where do they come from? Well, if you hold any mutual funds that are in post-tax accounts, meaning you've been saving like outside of an IRA, well, you've probably been getting capital gains every year. You'll get a little statement. It'll tell you what your capital gains were. Any stock that's held within a mutual fund, if the mutual fund manager decides to sell a stock in that fund, even if the value of that fund went down that year, they have to report that capital gain if they bought Apple at 100 and sold it at 300. And that gain gets passed on to you, the shareholder. And that's why you pay capital gains. So a lot of times, mutual funds aren't the most tax efficient vehicles for accounts that are outside of your IRA, for non-qualified accounts. If you rebalance, that could be another capital gain trigger. Maybe you have an investment manager. Maybe you own two stocks, right? Apple and Google. And you want each of them to be 50% of your holdings. Well, each year, if your manager said, oh, well, Google's now 60% and Apple is only 40%, we're going to sell some Google, buy some Apple, make it 50-50 again. Well, what they're doing is selling, which is triggering a capital gain in effect that you're going to now pay taxes on, even though all you were trying to do was balance out your holdings. The bad part about this in retirement is that, we think of long-term capital gains. You're like, oh, Keith, you just told me if I make less than $107,000, I'll pay zero on that. Or if I make, more than that, I'm only going to pay 15% on the long-term capital gains. The problem is in retirement, when you have all these income sources going around, when you throw Social Security into the mix, long-term capital gains can basically then trigger Social Security to be taxed and basically put you into an ordinary tax rate because of it. So it's really tricky in retirement. You really want to pay attention to what you're doing and how you're drawing your income to be as tax efficient as possible. Getting into Social Security, I'm going to tell you a little bit now about how that is taxed. So Social Security has this, calculation on how they figure out if your Social Security income is taxed. And this is where you might want to have that pen and a piece of paper if you had it handy before. It's called provisional income. What they basically do is they're going to take the Social Security Administration's, the IRS is going to take the full value of all the Social Security income that you receive, you and your spouse. They're going to add it up. So maybe you and your wife total get $40,000. They're going to take half of that number, $20,000, and then they're going to stack on top of it all your other sources of income, even including tax-free municipal bond interest, dividends, capital gains, ordinary income. It's easier for me to tell you what they don't include. What they don't include is Roth IRA income, and they also don't include any money that you had maybe built up in a insurance policy. Maybe you had a whole life policy that built up cash value. Well, the money that you take out of that whole life policy or any insurance policy that built up cash value is basically considered a loan to yourself. So it's your money. It's not considered income. So those are really the only two vehicles that are not included in provisional income. Here's the different benefit thresholds. And I just want you to keep in mind that for tonight's presentation, I'm going to be referring to, most of my clients are retirees or pre-retirees. We specialize in retirement income planning. And like I said, I'll just throw this out there. If anything I've said to you tonight, if you want to, book an appointment to talk to me one-on-one to talk about your situation, there's that offer. I'll probably throw that out there again for you a little bit later on. So I'm going to focus on married filing jointly over 65 when I'm talking. So we're going to talk the thresholds for a married couple, which are, your first $32,000, no matter what, of your Social Security income is going to be tax-free. Once you get above that, if that's going to be your total income, though. Once you get above 32,000, then up to 50% of your Social Security income can become taxable. And once you get above 44,000, up to 85% of your Social Security can become taxable. Now, I want everyone I know to pay as little as possible in taxes on all levels. So there's really some ways to strategize to minimize the taxes that you're going to pay on Social Security. Now, the good news is for everybody, no matter what, 15% of your Social Security income is always not taxable. Here are two different examples. And this is, I also do a Social Security class as well to kind of help people figure out when to turn on Social Security. But I'm going to give you a kind of a little hint right now. And that is, what a lot of people will do is they'll delay their Social Security right now so that it'll maximize. It maximizes at age 70. For every year you don't turn on your Social Security after your full retirement age, basically the benefit grows by 8%. Not too bad. And it's not, you don't have to wait the full year. It's like 0.667% per month. It's basically accounted for on a monthly basis. But the reason why you might want to delay your Social Security is to get your Social Security higher because that's going to increase your provisional income. Or increase your income and actually reduce things. So what we're going to do is two different couples. The first couple, they decided to turn on their Social Security early, and they got $20,000 a year. Both these couples need $60,000 a year to live on. So couple A, who took their Social Security early because they've been paying into it their whole lives and they don't want it to go away. They want to make sure they get their money back. So they turned it on early. So now they're forced to get $40,000 from somewhere else. So they happen to be taking it from, an IRA so that their total income is $60,000. Well, we've already told you how the provisional income is calculated. It's half their Social Security income, half of 20 is 10, plus the 40,000. So their provisional income is 50,000. So the calculation to figure out what part of their Social Security income is taxable is quite easy. You take the provisional income number, you subtract out that first threshold. The first threshold for that married filing joint is 32,000. You subtract out the 32,000, that gives you 18,000, and you multiply it by 0.5 because remember I said up to 50% in that level it becomes taxable. So that gives you a number of 9,000. So you drop that 9,000 down. Now what you do is you take the provisional income number, the same 50,000, and you subtract out the second threshold, the 44,000. You multiply that times 0.35 because remember I said up to 85% of your income becomes 85% of your Social Security becomes taxable. Well, with the first calculation, we've already taken care of that first 50%. So now we just have to deal with that next 35% to make the full 85%. So you take the 50,000, subtract the higher threshold, and you get 6,000. You multiply that times 0.35, you get 2,100. You add those two together, and so their Social Security income that's taxable is 11,100. So 55% of their Social Security income is taxable. Now let's look at the second couple and what they did. They delayed their Social Security until age 70. So the benefit grew higher. They had a higher amount. They still wanted the same income as couple A, but because they did that, they kind of strategized and they used some of that money early before they turned on their Social Security because they wanted to pay less in taxes down the road. So their Social Security income ended up being $40,000 a year. So they only needed $20,000 in IRA withdrawals. So their provisional income is $40,000. By having that lower provisional income, they're going to save money on taxes because less of their Social Security becomes taxable. We take half of their Social Security, $20,000, add the other $20,000 IRA to give that provisional income of $40,000, subtract out the first threshold, and we get $8,000. $8,000 times 0.5, $4,000 of their benefit is taxable. We go to the second threshold. The second threshold is $44,000. They didn't hit that threshold. So all of their Social Security that is taxable is strictly $4,000 of it is taxable. Only 10% of their Social Security income is taxable now. So you can see how, yes, they delayed their Social Security and they didn't collect as much money in the meantime, but they're going to owe a lot less in taxes and get a lot more money to lean on. Nowadays, people are living long and longer. And if you're wondering what the break even is roughly on Social Security, if you don't include cost of living adjustments, it's right about 80, just over 80 years old. But if you do include cost of living adjustments that Social Security does have, it can drop down to like your upper 70, 78 or 79 years old. Most people are living beyond that. Not everybody. Obviously, if you have a horrible history of family health or you're not in great health, I'm not going to tell you to delay Social Security. That would be ridiculous. But if your parents and your grandparents live to the ripe old age of 100 and you're a jogger and you eat broccoli and you're healthy, you might want to consider a delay. This is how that last example shows on the tax return. The people who took the Social Security income early, they ended up having taxable Social Security of $11,100 plus $40,000 of other taxable income, which puts them at $51,100. We subtract out their standard deduction of the $27,400, and they had taxable income of $23,700. That just pushes them into that 12% bracket, so they end up owing $2,449. Now, couple B, on the other hand, who delayed, their taxable Social Security was $4,000. Their other taxable income was $20,000. So their total taxable income was $24,000, which is less than the standard deduction. They owed $0 in taxes. So those are things you need to think about when you're thinking about, let me take my Social Security early. Yeah, it might feel great to be getting that extra paycheck right then and right there, but you're going to cause yourself to pay so much more in taxes if you live an average lifespan, in your high 70s, early 80s. And if you belong that, you're going to exponentially save. The other things you need to think about in retirement tax-wise are Medicare excess premiums. If your income is below $174,000, married filing jointly, then that's your Part B per person is the $1,735, and there's no Part D bump up. But if you're a higher wage earner, there is a bump up, and that's how you could potentially pay more in taxes. So even if you're a high wage earner or you've accumulated a lot of assets, there's still a lot of tax planning for you to do, because you could do Roth conversions. You could do all sorts of stuff to kind of manipulate the numbers and pay taxes now while they're cheap instead of waiting until 2026 when they get more expensive. The net investment income tax, again, is for high wage earners. If you're making over $250,000 as a married couple, the government's basically going to take 3.8% of your net investment income, or 3.8% of anything above $250,000, whatever is less, and that's kind of an additional tax that you would have to pay. The PEP tax and the Pease tax are eliminated. The Pease tax was named after Congressman Donald Pease, and basically what it did is it reduced the value of itemized deductions for higher wage earners. That's gone now. The alternative minimum tax, that is still in effect. However, it affects a lot fewer people now because they really dramatically raised the threshold. What the alternative minimum tax does is basically there are a lot of very smart high wage earners who kind of tried to manipulate the tax system and take advantage of every kind of possible deduction and credit possible so that they would owe nothing in taxes. Well, this kind of doesn't allow them to do that. It reduces basically the ability for them to use different types of business deductions and whatnot. If you pay the AMT, and you definitely want to work with a CPA to lower them. So I've talked about marginal tax rates and several of the different items that could potentially affect your taxes, but how does everything, when it gets put together, really affect things? And that's something I want to talk about, especially how Social Security can, once you have RMDs, Social Security, IRA withdrawals and all that, how everything affects everything. So again, this is that ordinary income tax map that I showed you before. 0% for the first 27,400, then 10, 12, 22. Here's that long-term capital gains where I told you if you have, long-term capital gain income only, and that's your only income for 1 year in retirement, you could have up to $107,400 in long-term capital gains and pay zero taxes. So just another strategy if you're thinking of selling a home or something that's really appreciated before you start turning on all your other streams of income. It's something you really kind of want to take a look at. This is an example of how the tax system is not intuitive at all, and how it can be very confusing with, where do I take out that extra $3,000 or $5,000 or $10,000 to buy my child a birthday present, or my grandkids, or help someone out with college tuition or a car? Like, where's the smartest place to take that money? These are things you really, really need to think about, because intuitively you say, Keith, you've already given me all the answers. I'm in that 12% tax bracket. I know that if I take out an extra $1,000 from my IRA, I'm going to owe 12% federal on that $1,000. That's absolutely wrong. And this is an example of how that's wrong. So this is John and Jane, retired, getting Social Security, $60,000. They've got $10,000 of net long-term capital gains, and they're taking out $52,000 of required minimum distributions. This is what their tax map looked like. They never even have a 10% or a 12% bracket. They don't have that. And they also don't, they do get into a 22% bracket at one point, but they get into some strange places before that. And you're saying, Keith, how can that be? There's no 18.5% bracket. There's no 22.2% bracket. And I know for sure that there's no 49.95% bracket. This has to do with how long-term capital gains can affect Social Security, how ordinary income and long-term capital gains can now force your Social Security income to become taxable. And how that works is basically that 18.5% bracket, that's basically showing the income that they have that's in the 10% bracket that is then pushed up their Social Security that previously wasn't taxable into that 10% bracket. Because remember, only up to 85% of your Social Security income can ever be taxable. So that's why you're getting that 8.5. You're getting 8.5%, 85% of that 10% bracket. So 18.5. Then that next level up is where they're into that 12% income tax bracket. Well, their income then forced their Social Security now go into that 12% bracket. It wasn't taxed before, but now because of the long-term capital gains, it's pushing everything up. And that 49.95% bracket, this is exactly how it happened. They took out an additional $1,000 from their IRA thinking, hey, we're going to buy a great Christmas present for our kids this year, right? $1,000 bottle of wine. We're going to splurge this year and go crazy because one of our children loves wine. So what happens? Well, that $1,000, just like I said before, I'm in the 12% bracket. Okay, Keith, it affects me 12%. I owe 12% on that $1,000. Wrong, because that $1,000 then affected $850 of your Social Security to now be taxed at 12%. So there's another 102. And what that additional 1,850 that is now taxable did, because you got the $1,000 withdrawal and now 850 of the Social Security now taxable. Now it pushes up the capital gains. 1,850 capital of gains that wasn't taxed before is now taxed because you now push it up in the 15% bracket. So that's how you're paying the total of $499.50 on an additional $1,000 from your IRA. So you really have to pay attention to these levels, because I'm guessing that you probably wouldn't want to take out that extra $1,000 if you knew you were going to give half of it to the government. You might think twice of where you took that money from to do it. The same thing can happen. This is an example as if they did the same thing but took out like an additional $25,000 from their IRA. You're going to get bumped. Everything gets pushed up. Basically, what they're doing is in that 22% bracket. Now they're kicking up Social Security into that, and they're kicking up more money into that 15% capital gains bracket that wasn't taxed. So it actually is 37.2, not 38. But you get my point. You have to really pay attention. It gets harder to control your income if you're not paying attention to things. While you're working, you're able to, contribute more to a 401k. Oh, I can contribute more to a 401k to lower my income. Or I can contribute to a traditional IRA to help lower my income. I can contribute to a health savings account. Those are all the tools that you have. In retirement, you're clearly the master of puppets. You control everything from ground day one, from when you retire. That very next year after you're retired and you don't have any sources of income, you get to choose where it's coming from. And you can be so tax efficient. You'll save yourself thousands to tens of thousands of dollars just by being and paying attention. Like I said, what I love to do is I like to educate. I like to help people save money. I like the people know that they're not going to outlive their money and that they're doing things the smartest way possible. It's not about dying with the most amount of money in your bank account or having this big pile. The biggest mistake that most retirees make is they go from accumulating their money to spending their money, and they forget to preserve it. Going through this most recent COVID, market tank and then back up again, that roller coaster ride. If you didn't feel comfortable during that whole time, then you probably were overly aggressive your portfolio might not be the way you want it to be in the long run. You might want to start thinking about that if you're getting close to retirement. The biggest mistake you can make as you're nearing retirement or in your early years is not preserving some of that money to weather these types of storms. But how you can really control your taxes, like I said, you want to have each type of account. You don't want to just have all IRA or 401k money. You want to have some Roth money, and you want to have some money just in your checking and your savings. You want to have these 3 different tools. So when the tax law changes, you get to pick and choose where you're pulling your money from so that you can adjust to any kind of tax situation, no matter where your income level is, and be as efficient as possible. If all your money is just in an IRA and you're not thinking like, hey, how can I make this more efficient now? You're going to be in a lot of trouble when the tax rates go up because you've left yourself with the only tool you have, which is money that still has to be taxed. So there's a lot of different things you can do. There's different products that can help defer tax dollars. There's so much you can do. I'm here to help. And like I said, I'm here to talk to each and every one of you one-on-one. This class is really meant as an intro, but I want everyone to take advantage of it. You send me an email. We'll set up a time on Zoom to talk just like you're probably used to at this day and age. Everything has changed. So I'm not quite doing in-person meetings yet, just trying to protect everyone, my 5-year-old daughter and my parents as well. I want everyone to be safe. If there's anything that this whole thing has taught me, it's don't take things for granted. We don't know what's around any corner, and don't take a single thing that you enjoy for granted. I want everyone to be happy, healthy, and safe. I'm a bucket planner. This just kind of gives you an idea of how we segment our money, not just in the different types of taxable accounts, but you should have money now available to you that's liquid and safe, your checking, savings, emergency savings. You should have money available to you in a couple of years that if you have a big expense plan, maybe you're buying a car in 2 years, or maybe you're going to retire in 3 years. You need to have some conservative money to start leaning on when you don't have a paycheck anymore. And then money you're not going to use for 10 years or more, you can maybe have a little more risk in that money. That's the type of money that should be in the stock market. So we kind of segment money, showing people, maybe the level of risk they're comfortable with and how to plan for the different expenses you're going to have in retirement, coordinating that with Social Security and taxes and all those things. So what I do is I try to make things as simple for clients as possible, but there's so much thought process that go behind things, trying to show people how to be as efficient as possible. I just want to give you a slide of that. Anyone who came to the webinar tonight, you reach out to me, you set up an appointment to do one-on-one. I'll mail you a copy of a great book. It's called The Bucket Plan. The owner and the founder of our company wrote this plan. It's a non-finance book. It's really meant to simplify retirement planning so you can understand the major concepts out there. It's great. My wife actually likes this book, and she hates talking about numbers and stuff. It's very easy to read. That's something I want to offer you. But basically, your own individual situation is going to be different than your neighbor, different than anyone you know. I advise you to get help on it, whether it's from me or from somebody else that that maybe handles this. Maybe your brother's an accountant, or maybe he's an investment advisor. Reach out to somebody. You want to do that little bit of work up ahead, that preventative medicine, to help save you thousands and thousands of dollars later in life. So that's all I have for you tonight. Thank you so much for coming. Again, I want everyone to pay their taxes, but I don't want them to pay a penny more. I'm going to leave up my email address right there for you, and I'm going to slide that offer out one more time for everybody. Thank you for coming so much tonight. Stay safe. And I know you might not like to, but I see everyone doing it in Rhode Island, wearing their mask when they're at the grocery store and at the store. So I really appreciate that. I know my family does. And, we're all in this together. We'll get through it. Take care. Have a great night.